Hello and welcome back to this week's market update. Today is Monday, August 26th, 2024, and we will jump right in. Stocks rose again last week as the Fed officially signaled they are ready to start cutting rates. We saw the S&P 500 up 1.45%, the Nasdaq not far behind up 1.4%, the Dow Jones Industrial Average up 1.27%, and even the Barclays Aggregate Bond Index up 0.65%. So overall, really since that quick sell-off that we saw in the beginning of August, we have regained most of that territory and we could be headed higher in the coming weeks, depending on how the market takes the next few weeks of Fed action, economic data, inflationary data, and so on. As I briefly mentioned in the last slide, a lot of last week's market movements were due to positive sentiment from the Fed at the Jackson Hole Economic Symposium, signaling that the Fed has explicitly stated rate cuts are ahead if economic and inflationary data continues on the trend that it is on. Markets quickly reflected this clarity that they got from Fed Chair Jerome Powell, with expectations for rate cuts becoming more aggressive than they were a month ago. Currently, markets are anticipating a full 100 basis points of rate cuts, as you can see in this blue line. The highest probability does remain on the idea that there could be 100 basis points in rate cuts by year end, compared to the previous expectation from markets that we would see 2 to 3 rate cuts in this light blue line here. So markets are becoming increasingly dovish on the hopes that the Fed will begin cutting rates aggressively by the end of the year. Moving into our more regular economic data, we had existing home sales and new home sales data come out last week, showing an increase in volume in the month of July as mortgage rates have been dropping into the summertime. There were 3.95 million existing homes sold in the month of July, which was unexpectedly up 1.3% from June, but still down 2.5% from a year ago. Inventory has also been increasing compared to a year ago. We had 3.3 months in July of 2023 worth of inventory. Now it is up to 4 months. So more inventory is sitting on the market despite the increase in sales volume in the month of July. Finally, we saw that the median sales price is up a pretty modest, historically normal 4.2% from a year ago, up to 422,600. So overall, higher volumes in the month of July, but still a lot of impacts from higher interest rates, and that could likely change in the coming months as the Fed begins to cut rates. Alongside existing home sales, we also got new home sales for the month of July as well. That showed 739,000 new homes sold in the month, which was up 10.6% from June and up 5.6% from July of 2023. So a lot more sensitive to these slightly lower rates that we've seen 30-year mortgage rates fall into the summer. We also saw that the median sales price of a new home sold is up to 429,800, 1.4% lower than a year ago, but up quite a bit from June's 416,700 as the median sales price of a new home. So overall, we see that new homes can be a little bit more reactive to interest rate changes compared to existing homes, but both got a boost from lower rates going into the summer. Last week, we also got the Conference Board's leading economic index, which shows a composite of multiple leading indicators, both financial and non-financial components. In the month of July, we saw the LEI fall by just 0.6%, so a slight fall in the month. It's no longer signaling a recession, just a bit of a slowdown ahead, according to the rate of change in the LEI. And then breaking down the LEI a little bit further, you can see that the leading credit index helped the index. The S&P 500 stock prices, that was also a helpful leading indicator, whereas interest rate spreads, aka the inverted yield curve, that continues to be a negative factor in the leading indicators. We saw that consumer expectations for business conditions continue to be negative. The ISM index of new orders, that's also a negative indicator here. Building permits, average weekly manufacturing hours, and those are primarily the largest movers in the month of July. So overall, leading indicators do point to a bit of a slowdown ahead, but they have shifted from pointing to a recession to pointing to just a simple slowdown in economic activity, not in negative GDP growth. So overall, leading indicators still look a little bit bearish, but less bearish than they did a few months ago. Last but not least, we have our recession indicator dashboard, as there was quite a few updates here. You can see we had the ADS updated on a weekly basis that remained bearish. We also had the Chicago Fed's National Activity Index, which actually turned bearish. It was previously neutral and now it looks bearish as of this month. So that's not a great indicator there. And then, as we just covered, the leading economic indicators index that has remained bearish. It's been bearish for quite some time. It's actually slightly less bearish than it was maybe 6 months ago, but still pointing to a slowdown ahead. So that leaves us with 4 bearish indicators, 2 bullish, and then 2 neutral. And this is not an end all be all by any means of economic activity ahead, but it does suggest that we might see a potential slowdown in the coming quarters. Thank you so much for tuning in to this week's market update and hearing our thoughts on recent market events. We look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.